Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. It is Tuesday, January 14th. We're going to take a look at Rogers Communications. This is actually a Canadian company here, but out of the communications sector. Before we get too far in the video, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you're subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever we put out any new content. I do this Stock Pick of the Day video series Monday through Thursday when the market's open. We take a look at a company that stocks pulled back on the day and see if it is presenting any value. There's some criteria we run through that we'll cover in the video. It's a high-level look at the company through my screener to see if it makes it onto my watch list. There is also the thanks button down below for anyone who's capable or wants to donate to the channel that way. And those funds will go to three separate accounts, my two daughters' custodial accounts and mine. I'll split that up evenly, and I will cover any of those funds as well, probably on my weekly portfolio update that I do Sunday, and be reinvesting as those funds come in. I don't make any money off YouTube, but that is one way potentially I can make money. The other way is just for you to keep watching the videos, do the things that I just mentioned, hit that thumbs up button, hit the subscribe button, hit the notification bell, and drop a comment down below. Let me know what you think of the video. Let me know what you think of the company. And for those of you who are already subscribers of the channel, special thank you to you people out there. The channel continues to grow because of people like you. Now, this is the Vested Interest Stock Screener. This is how we're going to run through the video here. We're going to run through this criteria. Must meet 5 of 8 to make it onto my watch list. And just because it makes it on my watch list does not necessarily mean I am buying the company. It just means I am interested in doing more of a deep dive into the financials of the company, into their balance sheet, their income statement. And I'm looking at stuff like, is their margins expanding? Is their revenue growing? Are they paying down debt? What are their PEG ratios? What is their price to book ratios? What are those ratios compared to other companies, price to sales? A bunch of other criteria that I'm looking at there. Are they expanding as a company? Really is what I'm looking for overall. But this is an initial screener that we'll run through in this video. Now back to Rogers. Check them out at their homepage, www.rogers.com. That is their homepage where I pulled this information from. That's www.rogers.com. Again, that is their homepage. And what are they? Well, they are a communications company, Canada's communications powerhouse, connecting over 20 million subscribers, right? They cover mobile phones, home connectivity, so your internet, business internet, top destinations, a leader in Canadian media business. So they're bringing you sports. So, right, like your local news. If you're a fan of, look like the Toronto Blue Jays there, maybe you're watching them on a Rogers network, and the best in entertainment. So they're a communications company that has their hand in not only mobile phones, home and business internet, as well as entertainment overall, it looks like. And the reason we are taking a look at them, down 2.79% on the day, we are talking about Rogers Communications, ticker RCI. Again, this is a company out of the communications sector. They are a Canadian company as well. Closed off the day at $28.55. 52-week low at $27.63. High was at $48.19. They are pretty close to their 52-week low. It looks like they're up a little bit in the after hours. Actually, it's a big jump up in the after hours as of at least 4:20 whenever I pull this information together. Market cap of $15.544 billion. So they are a relatively small cap company here. Beta of 0.61. So they are less volatile than the overall market. PE, price to earnings ratio, at $14.57 per share. EPS at $1.96 per share. Earnings date is January 30th. So coming up at the end of the month. If you're interested in that, you can check out their website. I'm sure they'll post it there. Or I'm sure they have an earnings call if you want to look that up. Forward dividend is $1.39. I believe they are a quarterly payer. We'll see that here at the end. This is the first time I've looked at this company myself. Dividend yield is nice. Starting dividend yield at 4.73%. Ex-dividend date, December 9th, so we're past that. Looks like they paid out on the 3rd. So you would be in line for their next dividend, but you're going to have to wait a couple months before you'll get the next payout. 1-year target, at least according to Yahoo Finance, $45.84. Not quite back to its 52-week high there, but definitely higher than where it currently sits. Jumping over to the right here, I like to look at dividend yield theory to see if the companies are potentially presenting any undervaluation. To do that, we'll look at their 5-year dividend yield average, 3.45%. Compare it to the current, 4.73%, or over here where it says forward, 4.73% forward annual dividend yield is the same as their current. Since their forward annual dividend yield or their current dividend yield is higher than their 5-year average, that speaks to undervaluation. These numbers are inversely correlated, right? So if it was lower than their 5-year average, that would speak to overvaluation. Right now, at least according to dividend yield theory, this one is potentially undervalued. Now, I like to look at the payout ratio as well. I like under 75%. They're sporting a 70.67% payout ratio. So it is starting to get up there a little bit. You want to keep an eye on that. Dropping down below, I like to look at free cash flow. I want growing free cash flow over time. Because typically, if a company has growing free cash flow, they're financially sound. They can pay down debt. They make acquisitions. They can reinvest back into the company. They can pay dividends. They can buy back shares. And I like it when they raise dividends, and that goes along with that growing free cash flow as well. Going back to December 2021 here, you can see 1.3 billion in free cash flow. 2022 was 1.37, so slightly up in 2022, but looks like they were down overall in 2023 to 1.1 billion in free cash flow. In the trailing 12 months back up to 1.7. Now they are paying down debt but not repurchasing shares, and the repayment of debt doesn't necessarily mean anything unless you compare it to the issuance of debt. But I did want to note that it looks like they are at least trying to actively pay down debt, but they are not buying back shares, it doesn't look like. Now, jumping over to stockanalysis.com, this is another source I go to for information. The previous page was Yahoo Finance. I'm not affiliated with either site, just two sources I go to for information, and I do recommend more than one source so you can make sure the information you are looking at is accurate and up to date. They do have 4 analysts that have taken a look at this. They call it a consensus buy, but if you look down here at the bottom, price targets were last updated on September 19th. So September 19th is a few months ago, well, more than a few months ago now, 4 going on 5 months ago. So the information here is a little dated, right? And that's why I say I recommend more than one source, because sometimes that happens. Sometimes they don't update on a regular schedule, and sometimes information is just wrong, possibly because they haven't updated. But they did call it a consensus buy in September. Low estimate of $46. It currently sits much lower than that. That would represent a 61.12% increase if it came back up to their lowest estimate. Average estimate of $61.75. That would represent a 116.29% upside from where it currently sits. And if it happened to hit their high of $74 estimate, that would represent a 159.19% increase in the stock price. And all the while, you could collect that 4+%, nearly 5% dividend yield. Now, I like to get into statistics, look at return on equity or return on invested capital to see how well a company is reinvesting back into itself. And a lot of time, these communication companies are very similar to utility companies. A lot of reinvestment back into the company, a lot of capital expenses there, updating lines if they have their own broadcast lines or equipment. You know, they might have their own facilities where they're broadcasting out of that may need maintenance. So there's a lot of cost around these communication companies, very similar to utility companies. But return on equity is sitting at 13.53%. I like 10% or better, so that's good. Return on invested capital, though, is a lower than I like at 5.15%. Both of these are like 10% or better, so it would not get a check. It's got to beat 10% or better for both of them. EPS growth is not listed. I like 5% or better forecasted over the next 5 years, and they do not list revenue growth either. Now let's go through their dividend history as we wrap this one up. Again, they are a quarterly payout ratio. They got them a little lower from stockanalysis.com than Yahoo Finance did, but still a little elevated, 68.97%. Yahoo Finance had them in the 70% range, under 75% still, but starting to get a little elevated. Dividend growth, they say negative. I'm actually going to call it flat because I believe some of this dividend growth that they are calling negative is because of price fluctuations in the exchange rate. Buyback yield is negative, so when they are doing it, they are not very efficient when they're buying back shares, negative 2.9%. Shareholder yield is positive at 2.26%. They do pay out on the January, April, July, October timeframe. That's off schedule for most companies, so I do like that. But going back here, you can look here. Right, it looks like they're right around 39, 37, 36 cents per share. Maybe there is a little bit of a decline. 39 cents, 38 cents in 2022 September. December was 36. March 23, 36. June 8, 37. I think this is fluctuations actually in the exchange rate from Canadian dollars to American dollars. So I think they're flat. So I'm just going to call them flat, but I don't see dividend growth on this one. All right, let's wrap this one up. Looking back at the screener, understand the business. They're a communication company, right? They're very similar to other communication companies, though they're not just in the cell phone and internet. They also have their own, it looks like, entertainment arm, sports arm, and news arm as well. So some media presence also. Growing free cash flow, no. We had the one down year. Growing dividend, no. I'm going to call it flat. Again, I think the fluctuation there looks like it might even be going down a little bit, but I believe that's due to the exchange rate. So I'm going to call them flat. But so no check. Dividend ratio of 75% or dividend payout ratio under 75%. Yes, they're in the 68 to 70 range. So they are starting to get up there. Check valuation based on dividend yield theory. Dividend yield theory says they're potentially undervalued. So check there. They are within 15% of a 52-week low, so check there. Return on invested capital was lower than the 10% I like. Return on equity was good, but they've got to beat both, so no check. And earnings per share growth is not over 5%. Well, it may be, but they're not. They didn't list it, so no check there. So it only gets 4 of 8. It does not make it onto my watch list. Let me know what you think of Roger Communications down in the comment section down below. Is it in your portfolio? Is it one you're watching? Is it one maybe you are selling? Maybe you're part of the downturn in the day and you were selling out of the company. Let me know why if that's the case. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So go ahead and drop them down below. And if you have a stock, a company stock like Rogers Communications you'd like me to cover in the Stock Pick of the Day series, go ahead and drop that down below as well. And dividend stocks, please. I don't cover non-dividend paying stocks. So if it's a dividend paying stock, I'll cover it. If not, I'll probably message you back and let you know that I'm not going to do that. But it is getting harder for me to respond to all the comments. So it's not that I'm avoiding you if I haven't responded. It's just I am getting more comments on my videos now, which is good. That means you're interacting, which is good for the YouTube algorithm. So appreciate everyone who is commenting, hitting the like button, hitting that thanks button as well, and the notification bell, and subscribing to the channel is the most important. All right, well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Thanks for tuning in. Thanks for watching, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.